interact with the attendees. And
I'll thank the Guntur branch of SIRC for inviting me as a guest speaker on today's topic. I'll be majorly covering the GST aspects which are required for finalization of books of accounts to be considered before the tax audit is being held. Just to get a demography of the crowd here and understand, so I would request members to just by show of hands understand that how many of us or how many of the members present here does compliance relating to monthly GST filing for their clients. A good 60-70% of the crowd does the monthly compliance. Taking it forward, the same annual compliances, GST 9 and 9C. Right. So I understand from the crowd that 60-70% of them are actively involved in doing the GST compliance, and many of them are aware of the provisions of GST. Now getting into these were monthly compliance, annual compliance, the assessment related, the basically what you can tell is the notices being received, representation and licensing, refund applications for the clients. So how many of the members represent their client for GST related affairs to the department? So now I see the number coming down. Okay. So I understand again that everyone here would be doing tax audits for their client. So till some time GST was a nightmare for everyone. Nightmare, still it is a nightmare for the fact that the amount of notifications, amendments which are coming in, to keep a track of it, one has to devote that kind of time. And as members being in practice, what we see is, do we devote time towards the client's work or do we upgrade? If we only do the upgrade work, then we will be not able to do the client's work, and ultimately the billing, other things comes into picture. The revenue of the firm, the existence of the firm is again. So somewhere what I wanted to drive out the point is, the compliance have become really robust. One has to keep themselves upgraded, as Madam had discussed, as Neha ma'am also had discussed, that unless and until we upgrade ourselves, we will not be in a position to serve the client in a compliant manner. So we'll have to ensure that we are upgraded in a timely manner, and thanks to Guntur branch of SIRC to conduct this kind of seminar, and thanks to all the members to be present on a September month, peak month of tax audit return filing. So just with this brief background, I'll take my presentation forward. So the way I have designed my presentation, the first slide, or maybe the second slide, is a disclaimer. Why is this disclaimer? So what I am speaking right now, by today evening there will be a notification which will amend that. The understanding will be complete haywire. So to have the clarity very clear that this particular presentation are my personal views, and each one has the liberty to have their own views. Secondly, I don't bring about the responsibility of the Guntur branch or ICAI. These are all my personal views, and basically some homework at the members' end has to happen with in relation to the law, the compliance, and the necessary filings to be done. So my point here, again, the illustrations which I will be providing are based out of my experiences with my client. So you may have a different experience, we can discuss on that and we'll take it forward. These are the disclaimers, broad disclaimers with which we'll get started. The presentation, the agendas of today's approximate 2.5 hours of seminar on GST aspects will cover the introduction, how GST has come into picture, journey till date, then the role of professionals, how it has changed after GST has come into picture. So keeping those things in mind, I'll just briefly take 10-15 minutes of the time in highlighting how the GST has been and till date what has been the journey of GST, role of professionals even. Then year-end compliance, which is a mandatory part where you will have to highlight to your client the compliance which one has to complete before even finalization of books of accounts. So year-end compliance, which would include compliance related, the input tax related, then you have the reconciliation. We get deliberate in detail on each of the points. So I've made the presentation in a way where it will take you to the background, take you to the year-end compliance which you will have to do before finalization of books of accounts. Then definitely you will come to finalization of book of accounts. I'll only restrict myself with regard to GST perspective, that is review of balance sheet, review of your statement of profit and loss account. So we'll take it only from the GST perspective, how this will impact your finalization of books of accounts. Then moving forward, even before the tax audit, is completed and filed, one has to ensure that the at least first cut draft of your annual return statement and reconciliation statement in 9 and 9C are ready. It is mandatory, though the due dates makes us to file it later on, but the paperwork, the working papers in relation to 9 and 9C have to be prepared even prior to your finalization of books of accounts. Then the most important aspect which is coming into existence or which has to be reported in the tax audit report, again taking this perspective from giving a background about this clause 44 which has a GST reporting and the reporting requirements which we'll have to do in the clause 44. Now to take this presentation forward, introduction, everyone is aware, GST got introduced 1st of July 2017 in a hush-hush manner, very hush-hush manner. So the background with which they were working on implementation of GST was there, but overnight you saw the TV, we are implementing GST effective 1st of July 2017. Now overall the GST has been a law which has subsumed various enactments which were earlier there, be it your central excise, your Finance Act 1994 service tax, your VAT laws. All laws have got subsumed and we have got the GST law. Now how GST law was enacted, it has its own background. To just share that certain provisions were picked up from central excise, certain provisions which were good in state law were picked up, certain provisions which were there in service tax regime were picked up. So that is the way the law has evolved and the draftsmen have taken the best sections. However, when culminating together, they have made certain blunders even. So overall, that is why you see so many notifications, amendment coming in every now and then. So having said that, GST has been more a self-compliant, a law which is into self-evaluating and self-complying GST indirect tax law. Now, so to see the GST roadmap, June 2017, you had notifications coming out in GST law, and so in June 2017, they came out with set of notification, which be it the normal notification plus the rate notification. So these notifications, when they came in, so you had certain rate notifications which made the HSN code wise identifying of goods and services. HSN code, SAC code wise you had identified tax rates. Then you had certain exemption notifications which gave exclusive exemption to certain goods and certain services. So as it got evolved, we'll see in the small screen itself. So over the 5 years of existence, 5 years and 1 month, maybe completion of GST, so there has been tremendous plethora of notifications which have been issued, the amendments, the amendment bills which have been passed in the Finance Act. So each amendment, had it been earlier, if you would have seen in the budget, once you bring in the Finance Act, the indirect tax implementation or the effectiveness of those amendments would be effective the midnight. The next day, these provisions will get applicable. However, in terms of GST, what has been happening is, you give a notification, you bring in the amendments with an effect yet to be notified. So, one has to keep a track of the entire amendments which have been coming into picture, and not only that, from the date effective it has to be implemented or be effective, has to be noted. Sorry. So just to give you a background, that over the time when it got evolved, supplier with in June, as I said, you had various notifications being issued. Then in October 2017, they actually dealing the time of supply with supply of goods. Reason being that once you collect any advances for your goods, it was liable as the law prevailed. However, they felt it very difficult to keep a track of it, and hence they had to revert by making this time of supply. They dealing this particular receipt of advance in case of supply of goods. Moving forward, then the composition scheme came in. Then what happened was, they gave a threshold limit, the turnover up till 1 crore rupees, and in relation to certain specified states, it was 75 lakh rupees. Moving 2017, they brought out a e-commerce operating without mandatory registration. You could operate, you need not get registered under GST, and you could have transacted with e-commerce operators. Supply of services, mind you, it is supply of services which were provided to e-commerce operator were given a leeway. In April 2019, the turnover limit for the composition was increased to 1.5 crores. Next slide. Slideshow. No repeating slideshow. F5. Can we connect my laptop?
I'll just take
1 minute. We'll continue. So, again, April 2019, they came out with composition scheme for supplier of services. This is the first time in any indirect tax law that they brought in a composition scheme for supplier of service, composition scheme for supply of services. Again, as the GST law evolved, they had to increase the limit of turnover from 20 lakhs to 40 lakh rupees. For registration under GST, the turnover limit was increased from 20 to 40 lakh rupees. Then, October 2019, they came out with making that annual return optional for people having turnover less than 2 crores. We will deliberate in detail the powers which were given from the Act through the rules and the notification. Now, usually what happens is, in any enactment, you have the powers getting conferred from the Act. The prescribed rules, the procedural aspects is governed through the rules, and certain amendments or certain aspects of clarifications are only given through notification. This entire gamut of giving notification or making amendment through notification has been seen only in the GST law. So the powers have been delegated to the GST Council, and through the GST Council to the various commissionerates, where they issue notification left, right and center and make the amendment. And further, they reviewed on those notification itself. Moving forward, January 2020, they had extended the filing of various forms till February 2020. Now, so this is the way in which the GST law has evolved. They have learned from experiences that someone who has wrongly made the payment in wrong heads, why should they keep those amount in that particular ledger? So for that aspect, the transfer of cash ledgers was brought in through PMT 09 in April 2020. Then, to facilitate filing of nil returns for various GST registered person, they brought in a scheme where they will be able to file the nil return through an SMS itself. So they have evolved in such a way that one SMS and your nil return is filed. And September 2020, they came out with this important decision wherein Section 50 was amended or given an interpretation that the interest liability, if any, would be only on the net cash liability. Suppose I had a outward supply and a liability of say 1 crore rupee, and I had input tax credit of almost close to 99 lakh rupees. What Section 50 stated that if you delay in filing of your return, you would have to pay 18% interest on your outward tax liability on 1 crore. So this was the interpretation which many of the officers were drawing. It brought in many litigation, and then they had to intervene and give an interpretation stating that no, it is net cash liability. If you had an outward tax liability of 1 crore, you had an ITC of 99 lakh rupees, and you were only defaulting on 1 lakh rupees, which was to be paid in cash. So your interest liability will arise only on that 1 lakh rupees and not on 1 crore rupee. That again, the clarification came up after 3 years of GST. The law was there. 3 years they took to interpret that particular thing. Understanding the difficulty, they came out with this particular clarification. Then January 2021, to further ease the compliance burden of the registered person, they brought in the quarterly return scheme. God only knows. And in my office, definitely we don't follow the quarterly return scheme. To drop those ITC related workings, to drop the ITC related payments which have to be done before 25th of the subsequent month, 33%, whatever it is. It was again, as regards the client, he would request quarterly, then you are filing only quarterly, right? So you charge me only on quarterly basis, 4 quarters, four times you can bill. However, if you are doing it monthly, 12 billings. So client were getting smarter. They didn't understand the challenges which one would face with the QRMP scheme. So QRMP scheme brings in about a deemed concept where you deem your turnover will be this much, your ITC liability will be this much, and basis that you will have to make the payment. However, your monthly returns which you are thinking, you are doing it on actuals. So you know the workings, you know the calculation, and the basis that you are making the payment. Then June 2021, so they brought in a scheme. What scheme was it? Voluntary compliance kind of thing for return filing. Whoever has missed out on the return filing. So earlier the delayed filing, late filing fee was up to a maximum of 10,000 rupees. So till September 2021, if someone would file the returns, they had given a scheme. In my own case, for my client, just before this scheme was introduced in June 2021, I had filed for my client, I made him pay 1,80,000 as late fee. The client was furious. He told me that department will come out with some relaxation, they will give some relaxation, you don't make the... So I said, no, department will not come out with any scheme, in the sense that you have to do the compliance right. You had not done it right, so you pay the penalty and file it. To my shocker, surprise, or whatever you can tell, the department came out with a return compliance scheme and they gave 1,000 rupees only. So where 1,80,000 and where was 18,000 rupees? I filed 18 returns for the client. Every month we paid 10,000 rupees on an average as a late fee. 18,000 versus 1,80,000 rupees. Client was very furious, but I said, see, this GST law, from that day I have ensured that I will not commit on anything, and hence the disclaimer on the second slide. Okay, evening they will change through a notification, right? So, moving forward, this again got evolved. I have just pointed out key highlighters on the GST. There are, if I have to highlight, it may take me 3,000, 4,000 slides to give the amendments. These are the kind of amendments which I have brought in the GST law. I have just highlighted the key highlights just to give you the background. Then in August 2021, a major change was brought in by bringing in or by dropping in 35(5) and making the GSTR 9C, the reconciliation statement, as a self-certifying thing. So once it was made self-certifying, we felt, yeah, our revenue, we were certifying, we were charging the client separately for it, that revenue has gone. For me, I have made it very clear for my clients that if you are able to do it, kindly do it. And tomorrow if you receive any notices for your misstatement, the client could not understand that what work we are doing. For him it was only another form, another reconciliation statement. they didn't understand the background with which the work was happening. So to highlight to them, I had to give away certain clients. You do it. You do it from your end, and you will realize that how much of a pain point it is to reconcile each of your data line wise. Not only turnover, not only your ITC, but also your payments also. So all three types of reconciliation you do, and then file the form 9C, and it has an onus on us. If we have any misstatement done, again, I was very cautious post that particular incident with my client on the late fee. So I said, see, I will be very safeguarded. You do the activity, you don't want to pay me the fees, kindly do the filing yourself. So though it was a self certifying thing, the client insisted that the complexities will not be handled by my team or my accounting professionals. So you will only have to do that because we have been doing it. This particular did not have much of impact on revenue folds. Reason being that the amount of fee which was charged only on the certifying aspect was reduced. Rest of the work was always there. The client insisted that we as a professional continue to do the annual return filing work also. Now, special schemes for BRICS April 2022 which has come in. In all these aspects I have not covered key things which GST has brought otherwise. Your e-way bill, your e-invoicing. E-invoicing again, in a scattered manner they have implemented, but those are going to be a game changer. The nuisance which have been caused through the bill trading activity, or they want to curb that. People are finding their ways out, but it is a game changer. E-way bill and e-invoicing, and slowly, effective 1st of October 2022, it is getting implemented for all registered person who are having a turnover of more than 10 crores. And I will not be surprised that effective 1st of January 2023, for more than 5 crores, e-invoices is applicable. So that is the way the government has been implementing this, a forced manner or whatsoever, they have been doing it. So this is the way the implementation has come in, and this has only, when I tell you this, it has only increased professional opportunities for chartered accountants. Let's be very frank. In my office, the day I started my independent practice, I implemented time management software. So which task I need to allocate, my team members, which time, what task they are working on, everything was getting tracked. So that helped me in negotiating with the client that the amount of time we are spending on GST compliances, GST reconciliation and other compliance activities of the client, we had clearly highlighted them the timesheets, and we were pretty successful in getting a revision in our professional fees. So a humble request to the members here, that someone who has not implemented it, is high time that we implement. We are not actually gauging. We are working on the traditional approach of the practice, where we are only, whatever is the last year's fees, we charge the same thing, or maybe an incremental thing. We are not linking that to the time spent for the client. The advantage we have is a separate aspect of the continuous client, the continuous work which we are doing. The request, it is not given in my PPT, but as a flow, a humble request to all the members that they kind of appreciate the time spent. Your time is precious. So once you have a tracker of your time, you will be able to discuss the fee related aspects to the client even, and client will appreciate the way in which you have the controls in your office. So moving forward, roles of professionals, like I said, like I started, and the way the background has been given. So I took a demography of the members here, who are taking care of the monthly activities, annual activities, There are clients who will give all in all. I don't want the headache. Direct tax, indirect tax, I am dependent only on one professional, he has to take care. So over the period and post GST, mind you, the scenario has changed and one has to appreciate the time spent on these activities. So just to give you an insight, the all in all assignment are a diamond, very difficult to find. Maybe someone specializing in all the aspects. A mid-sized firm would do that, but you will find that you are lacking on certain aspects on core competence. Maybe you should have a team of a bigger size. Your partner should take care of direct taxes, you should take care of indirect taxes, whatsoever it is, and ensure that the client is having a one-stop solution at your disposal or within your firm. So that way, what happens is you have the engagement of the client for both direct tax and indirect tax, and a composite fee for the same can be discussed. The point again which I am driving is we are not interested in understanding the fee aspect, but the comfort with which you will be doing the compliance of the client, both in direct tax and indirect tax, will be tremendous. Now coming, you may be a GST retainer. GST retainer in the sense they want an exclusive person who is filing all the aspects of GST, that is GSTR 1, 3B and your 99C. You can have a composite. What is your role in relation to providing the details to the tax auditor? You are only an exclusive person who is taking care of the GST related compliance, GST retainer. Your role is a major role in terms of giving the reconciliation. So somewhere it would mandate that we as a member would have to help other professional to carry out his duties depending on the standards of auditing also allows that if you have to depend on work done by some other chartered accountant, then it has to be looked into. Then there are certain activities which again came up in relation to annual return filing. You may find clients who are doing the monthly activity, their accounting personnel will do the monthly activity. You will only be given the activity which is an annual return, basically annual return or a reconciliation statement. So you will then have to sit down with the accounting auditee or the accounting person of the auditee, reconcile the difference on the monthly basis and then draw up the annual returns. Now, the tax auditor. I have been into a traditional practice of only direct taxes. Gone are the days. Post GST coming in, you will have to embrace the change with grit. And you should have resources who can do the compliance right. So that is the reason one has to appreciate the indirect tax amendments, and also like highlighted in the inauguration speech, that you will have to embrace the technology, you will have to embrace the changes which have come, you have to upgrade yourself. GST also you need to upgrade them. So once you are through with it, before even finalizing your books of accounts, you will have to look into certain key year-end compliances for your client. This year-end compliances will be taking a forefront or front seat in you getting engaged as a retainer, not only as a retainer, as an advisory to your clients, multifolds. So compliance related, see, everyone must be aware that every year your client has to change the invoicing series. It has to be unique. This again is governed through section 31 read with section rule 44, that invoice series has to be unique every financial year. So as soon as your March ending comes, a flyer from your end to your clients stating that you will have to ensure that the invoice series are unique every single year. It cannot continue from the previous year. The aggregate turnover, why this aggregate turnover needs to be calculated based on your e-way bill or this particular invoicing, e-invoicing. So e-invoicing has come in a scattered manner. So for 50 crores, 20 crores, 10 crores, matter of time it will come for 5 crores legal. So for that, your earlier years aggregate turnover is the criteria to be looked into for applicability of certain provisions. Then the LUT certificate, if a client is into export of services or goods, he has to mandatorily apply LUT certificate if he doesn't want to pay taxes on zero rating sales. Right? Now, then the mandatory update of GST RC also to be taken care, additional base of business which you may not be aware of, the client would have taken a new godown, new warehouse. So those things are all compliance related. So that needs to be taken care at the year end. These are activities again which has to be taken care duly before your tax audit is being done. What if I have not filed my LUT for the current year? See, this is not impacting my previous year. Previous year I would have filed. Current year, you will have to ensure that it is also being done. Now, coming to reconciliation related. Reconciliation related is important aspect of the year-end compliances because the turnover declared as per the client in 90% of the cases will differ because the GSTR1 3B mismatch, GSTR1 versus e-way bill, GSTR1 versus e-invoicing, GSTR1 versus books, entire thing there will be a mismatch. You will have to sit down and reconcile the turnover. The turnover, the client would tell, I have earned a commission income in my personal file. I am registered in GST, I am carrying out a business. I have earned a commission for my real estate transaction. Why is GST bothered about my commission income? So that particular knowledge, that particular provision of law needs to be clearly highlighted to the client that no matter what, it is an outward supply, you are a registered person, any kind of outward supply will be liable under GST. So the turnover will impact, based on this turnover, your tax liability may impact. What happens if you finalize with the wrong turnover? You are giving a wrong financial statement, it is not giving a true and fair view of your financial statement. So important aspect of a tax audit is it has to give a true and fair view, and basis that your books of accounts you file your tax audit report. Input tax credit. The mess with which this activity is being done. I can tell you, I have handled so many the roles of professional which I decided, which are this PPT has been prepared from scratch 3 days back. So I have given my personal thoughts on how I am handling my clients and how as a person in practice will handle his clients, and will have to give all the nitty-gritties, all the issues which come up, so that professional brothers are aware and they don't they completely take care of before signing their audited tax audit or audited financial statements. So now ITC related, I have come across various or you may also come across certain clients where the activities are done on a monthly basis at client's disposal, and what happens is you sit and do the reconciliation. The working papers are not there. Had the returns come in the traditional way, GST 1, 2 and 3, you wouldn't have found those difficulties. Today's scenario, what we are filing is GSTR 1, which is the turnover related outward supply, GSTR 3B, which is a summary return which is being filed. So the breakup of your ITC availed, utilized, those breakups are not clearly visible from the return itself. You will have to scout through various files of the client to identify what were the line-wise entry for which the credit was taken. So that becomes really a tiring task to do a tax audit, even to do a reconciliation of ITC. Now ITC, the government has come out with their own way of giving a reconciliation. So they have their own ways. Has the client done it right? Just to give you a scenario, if the movement of, say for example, automobile industry, the manufacturers are located in north, some dealer in south, he has a shipment going out of the factory from the north in the month end. Bill is raised on the month end. What happens? The shipment takes almost 5-6 days to reach the dealer's location. However, the bills have been raised in the month end. You as a professional, I as a professional, what we do is, we look into the books of accounts, we look into the 2A of the client. Oh, okay, this bill has come, this has been accounted for, we'll take it. Have we followed the rules right? Can anyone tell me what we have done wrong in relation of claiming ITC? I need answer. Let's make it little interactive so that it stays good. Yes.
So we are not looking out for ineligible credits. So we are not able to look at every transaction and check whether this is eligible or not. So
I'll make it very specific to this particular case. I am telling you that there are automobile industry, say spares are moving out. So those are eligible for credits, ineligible to the recipient. From a dealer's perspective, that is an ITC. So what happens is, the conditions mentioned in section 16.2, it has 4 stipulated conditions. Now 16.2 AA also has come in. So what now, if you have to go through that, you should have a valid document, invoice in your hand. The material should be received by you. So when the material has moved out from the factory, it has month end. When you have received it is this next month. So effectively the credit should be taken only in the next month. Department, it is matter of time that they will come out with this particular thing. Earlier central excise regime, you had a GRN, RG23 register or something to take care of this particular. When you have the movement outside, you take the credit. Basically when you receive the goods, you take the credit. So this is a challenge, and we have seen 2A, 2B coming in. So one, map your 2A versus 2B, you map your books versus ITC as per 2A, books versus 2B, and carry out a year-to-date reconciliation also for the client. So as a process, in our office, again I am giving a live scenario, we have started maintaining ITC line entry wise for all our clients effective 2018 onwards. So today my office is running on a pilot model, compliance is happening. We have ensured that the checks and controls are very clear. As and when the laws are getting amended, we have also trained our staff. So effectively, what one has to ensure is there is a regular training of staff which is happening at your office, a particular session, both in terms of law, in terms of procedural compliance, in terms of the technology, say your Excel sheet upgradation or maybe macros and other things. You will have to upgrade the softwares. Third-party softwares are there which are helping out on the reconciliation aspect. One has to keep a track of this particular thing. Moving forward quickly, payment related, the reconciliation, this has been a major factor. People never reconcile, and clients, they hand over cash for payment of GST to the auditor and never account for that in their books of accounts. This is a peculiar case. We have identified certain transactions where it is reflecting in their payment schedule, but there is no trace of this particular transaction in their books of accounts. When we report these kind of transaction to the client, he says, oh, I remember I have given cash to my auditor, he has made the payment from his account, so I have not accounted for. So that is when we come to know that the client is making payments through cash also, and there is some source of income which is coming to him in cash even. So that is where the checks and controls are there. So one has to do a reconciliation of the payments also of the GST. Input tax credit, we have deliberated much. Like I said, 16.2, if you have to go strictly per se the law, you cannot take the credit unless and until you have received the goods. So if you have taken credit when you have not even received the goods, the department can knock your doors, claim that particular ITC which you have wrongly availed, make you pay that in cash ledger along with interest. Now, 36.4, I don't know how many of them would have followed. I need a consensus on or a demography on how much of the members have followed for their clients. Rule 36.4 was basically your 20%, 10%, 5% over and above your ITC reflecting in your GSTR 2A. So how many of them have applied this rule? So you didn't find any difficulty in mapping it. So it is we in fact my office spoke to each of the clients. We clearly stated that we are not going to apply this rule. You will face only a small working capital issue. However, you will be clean to the department, stating that you have not taken any excess credit. Tomorrow, to prove this, that the 20% was this much and I was available, it was eligible to me, department is not accepting today. GST department will come 4 years down the line and will tell, how did you apply this rule? They are still in current scenario where they are telling, show me as per 2B how much you have taken for 18-19 also. We had to write it in, I kept it in writing stating that 2B has only come in July 2020. You are asking me for 18-19 2B, not possible. So these are the things which you will face for your clients. Then getting into law related, there is a mismatch between your books and GST return filing and annual return. Your cross charge, your the expenses provisioning which is happening, it will not match with GST return filing which you have done. Just to give you a small example, say for example you have an asset which you have purchased, a windmill. It will take at least 6 to 8 months or 10 months to get installed and be available for use. In the books of accounts, we have a Ind AS or accounting standard compliance. We have to ensure that it is as per from the date of use. However, in terms of GST, once you have received the goods, you have the invoice, everything can take the credit. So those aspects you will have to have a clear reconciliation done. These may seem minute but are quite huge. Just to give you another practical experience which I had with my client, the client had never taken the credit of windmill. Windmill per se, when you purchase, you have to pay the GST, and the generation of electricity happening to that windmill is exempt. So client, they never bothered about taking the credit at all. They were right in one sense, at that particular juncture they didn't take. Client somehow got a good offer, he had to sell that particular windmill as windmill. Believe me, the transaction was in crores and they had to pay 18% extra GST because they forgot to claim the ITC when they had purchased and reversed it. Had they claimed and reversed, they could have reclaimed it and reduced their GST liability. They didn't do it. They didn't even claim it. So this understanding had brought in a loss to the client in crores. They sold the windmill as windmill. As a product, when you purchase and you sell that particular thing, you are eligible to ITC, right? So the intention was different at the time of purchase, but the transaction subsequent to it happened such that he had to sell that windmill as windmill. He could not take the credit at all. And these are quite huge in numbers. It will impact the profitability big time. So we had to advise the client to give a rollover effect of all the ITCs, claim that ITC backdated, and then again not to incur that particular payout as an outward supply on sale of windmill. So these are all advisory which comes part and parcel of your review. You will have to ensure that you are at least updated enough in ensuring that these compliance are there, and you can then get yourself groomed to an advisory model for your GST compliance. Now, finalization of books of accounts. this is where our team members will have to look into. I have more so taken steps to ensure that I highlight those points which you have to take home from a GST perspective. Take the balance sheet. Balance sheet, you will have the plant and equipments, the fixed assets, you will have the inventories, trade receivables, current assets, cash balances, and the GST net liability. So the reason which I have pointed out these assets is that these all have a GST impact, and you will have to ensure that you don't miss out on these aspects. You will have the checks and controls before even your tax audit is getting filed. I am pretty sure that each of the cases which you will be handling or you will be signing the tax audit report will come across situations where it will change the material aspects of reporting of financial statements. And from the liability side perspective, it is trade payables, your sundry creditors to whom you make the payment, your supplier, import of services, trade payables. We'll look into each of the activities. That is the reason I have deliberated or I have bifurcated that our discussion of review of your books of accounts from two perspectives. One is the balance sheet, taking care exclusively of GST affecting items, and your profit and loss account, revenue side and expenses side. So, quick look into, just one second. So, block credits, ineligible credits, like highlighted 17.5, you will have, usually we have a practice of just looking into the GST 2 and taking the credits. We don't get into what kind of nature of supply is being made by the GST or the supplier. So, just to give you a thought, I would have purchased a vehicle, SVN Motors. I get a huge credit. While filing the returns, if I don't look into it, how do I identify it as a block credit? So that skill set, that approach has to be built over the period. So wherever there is a cess, when you purchase a vehicle, you have a cess coming in. So you cannot take the credit. Only certain industry has that credit eligibility of cess, otherwise there is no. So one few ways of identification is you have cess coming in. So what is the client who has purchased which is liable to cess? So same goods, your luxury goods, cars will have cess coming in. So those credits are blocked under 17.5. These credits should not be taken into consideration. And what happens if you have taken the credit in the year end? You can reverse that particular thing, take that as a cost, claim depreciation also. If you finalize without doing that, you end up losing both ends. One, you will have to pay the GST liability in cash for wrong claim, and in the asset side, you cannot even add back that to the asset. Okay, so understanding from the assets perspective, you need to look into. The car example is right here. Fixed asset purchase, it's a block credit. You can take the entire cost of the car, including GST, in your fixed asset and claim depreciation. Assets in custody of third persons. By this, what happens is usually your molds, jigs, you work with a job worker. If you're in a manufacturing industry, you want certain setups to be done by or certain activity to be done by your job worker. In that scenario, what happens is you tend to give your molds, jigs to your job worker. In that case also, you are eligible to take the credit. And the procedural aspects with regard to the GST has to be taken care of. For aspects, in relation to books of accounts, your asset register will have that the asset is located at job worker's location. In terms of GST, one has to look into molds and jigs for a period of 12 months can be given to job worker. After that, it has to come back to the principal. It can further get extended by 24 months. That is, in total 3 years, it can stay with the job worker. Procedurally, it has to come back to the principal. If it doesn't come back, then it becomes a deemed supply in GST, which majority of them, at least for a namesake, it has to come and go back. So, majority of the cases where the manufacturing is there, this particular aspect has been never looked into. Mold jigs are 5 years, 10 years, it has been only with the job work. In GST, that is not the case. You will have to get back those mold jigs and send them back again. So the periodicity or the limitation period is applicable to those assets even. Otherwise, it will be treated as a deemed supply. Next, RCM import of services. This again, to give you an idea, suppose you are constructing a shopping mall. You want an architect from US, architect from Canada to come and give the architect services. Though the services are being rendered or given on paper and then send it across, or maybe the architect services. So these services, the client may, what will be done by the client usually is, it will add it to the fixed asset. He will forget to do the compliance in relation to reverse charge mechanism. He is importing certain services. The place of supply in relation to architect services for a property to be located in India is in India. So import of services, you will have to ensure that the RCM is being paid. It has been paid. Whether it is eligible? Eligible.
No, it's immovable property. Relating to immovable property, not
To what extent? So that is where he has given one part of the answer, that if it is in relation to an immovable property, and I specifically have taken this example where you have taking architect services. Architect services will be provided for your construction related activity, and to the extent it is in relation to an immovable property. In relation to an immovable property, if it is capitalized in the books of accounts, then it is a block credit. Mind you, if it is capitalized in the books of accounts, then only. So a clear reading of 17.5 subclause C D, works contract in relation to immovable property, goods or services. So it includes alteration and other things, and architect services also gets included. If the client has capitalized that, and if he has not paid RCM, you have identified that before finalizing of books of accounts, then he stands to benefit. Consider a scenario if you have not identified before tax audit, after tax audit, what happens? The liability comes, then the reporting of 2 years gets affected, and you lose. Again, similar case what we have discussed, that how the car, in the car example, if you are not paying, see, you will have to pay the GST under reverse charge. It is a block credit and it becomes a cost. So by passing journal entries, the cost of the fixed assets should increase by the architect fees plus the RCM GST you have paid. If you don't pay, what is that? I will not pay. Department are very clear. They will come out. The payments to architects are not small sum. It's a huge sum. If it comes at a later point of time, it comes along with interest and penalty. So a point to be clearly looked into from a tax audit perspective is there any construction activities happening? Is there any import of services in relation to the construction activity? In that terms, even if they have not paid, like I said, year-end compliances, this you can do it prior to September. What happens if you do it after September? Nothing, zero. You will have to pay along with interest and you cannot claim it in your balance sheet either. Okay? Next. So disposal of assets. Another interesting thing which you have to look into when you're doing the tax audit. This basically the client would give you the fixed asset register where you will have clear identification of additions, deletions. When you look into deletions, the pointer is very clear whether this particular asset which you have sold from the block, did you claim the ITC under GST regime or old regime? You will have to take decision based on those particular aspects. The reason I am telling you this is, there is a certain norms, certain section 18 subclause 6 identifies this scenario, and if you have purchased any asset and if you are disposing before 5 years, for every quarter 5% you will have to reduce and then you will have to reverse the ITC, or the value in which you are selling and the tax rate applicable to that, whichever is higher, you will have to discharge the liability. So there is a proper procedural norm, the provisions are very clear. You will have to ensure that it is done. These provisions may not be known to the client. Client will do, if he has to do the mathematics, he will do the thing very clearly. Now, if you are selling the car even, suppose a company is selling a car, what is the tax rate which you will apply? Usually cars are at 28%, which says, if I am selling the car, what is the tax rate? I hope you would have come across in 5 years' time, you would have come across certain scenarios where your clients would have sold cars.
18.
Is there only one rate of tax?
1828.
1828. Any other answer? There are only two rates, 12 and 18. It is not 18 and 28. So car sold as car, that is second hand car. If it becomes a second hand car, 12 and 18 is only the rate. If you are a dealer, then 28% is applicable. So what I meant is a used car in the company which is getting sold. You are selling that car. It will be 12 depending on the size of the car and the engine capacity, and 18% if it is a higher. So one has to keep a track of it, and again the mechanism is very clearly given that you will have to identify if you have claimed the credit. In car's case, we have not claimed the credit at all. While disposing, I will have to consider zero or whatever tax rate is applicable on the car sale, whichever is higher, will be the GST liability which has to be paid. Now, right to use, this I have already touched upon. I will quickly brush up. Like I said, windmill case where the usage, the Ind AS requires that as and when the use is coming, you will have to claim the depreciation otherwise. In terms of GST, that is not the case. Once you have received the goods, whether or usage has started or not, you can claim the credit. So, we have discussed fixed assets. Now we are going into the next stream of inventories. What if you are looking at the balance sheet of the client and you come across this closing stock? The point in terms of tax audit clause number say 14, you will have to identify what is the opening stock, closing stock, purchases, sales and otherwise. You will have to give those details. HS and wise details have to be maintained. I don't know how many of the clients would maintain these kind of details. So a proper disclosure to that effect in the tax audit report is mandated, that the books of accounts, in fact GST law mandates that you have a stock register clearly maintained. If you don't maintain, there is a penalty of 25,000 rupees for non-maintenance, and it can further get extended. So wherever the stock registers are not maintained, one has to look into and give a proper reporting in the tax audit report. This is from a GST perspective for a reason that you may have these kind of scenarios coming in. like I said, we have already touched upon this particular scenario also for goods in transit. The materials, the stock is moving at the month end, you receiving it in the next month. So the credit to that extent should not be claimed. It is very clear in the month in which you have received the invoice. It is only in the month you have actually physically received the goods is to be taken into consideration. Right? So, same way, goods sent to job workers' location, there is a mandate that it comes to you back within 180 days. The things which you have sent for manufacturing job work purposes, it has to come to you within the specified time limit, and if it does not come, it becomes a deemed supply under GST law. So, to ensure that this particular aspect is also well covered, this you will have to consider. You will have scenarios where, depending on the client's nature of business, they would be sending certain materials to the job workers' location. More specifically, looking into vouching the last 1 week of the transaction, that is year-end transaction, or so this becomes a monthly activity even, but for tax audit purposes, at least last week of March, when the materials have moved to the job workers' location, and when we do the audit, if till that particular time, if it has not come back to the principal, then it becomes a clear case where you will have to take into cognizance the events occurring after the balance sheet and give a reporting in a such a way that this becomes a deemed supply, and whatever provisions are applicable under GST are duly taken care of. These are the things which we usually miss out on a bigger manufacturing concern, on in fact a retail client even. The example which I gave for a distributor of an automobile car will have this kind of scenarios. So one has to be very notably, they have to note down these transactions and then take appropriate action. So now goods sent on approval. Usually this happens on a jewelry business. They send it on exhibition, they send it on goods on approval basis to different locations. On receipt of a confirmation that this sale is getting transacted, one has to issue an invoice. So for the physical availability of the goods, it may not be available at the disposal or in the books of accounts. It should be mentioned as goods in transit only, or sale on approval basis. The closing stock should be there. When you physically verify the stock as on 31st of March, there are these elements which a statutory auditor should look into. How much of goods are in transit, how much of goods are not in possession of the principal, how much of goods have been sent to on an approval basis. So once these things are looked into, the aspects fructifies only when the approval is received, and this can be in a different time frame. Basically, you would have sent it on 28th of March, and the approval would have come only in 10th of April. So 10th of April becomes the effective date of sale. So one has to be clear in how it has to be looked into. So this again aspects we have covered, that as on 31st March, if the stock, physical available stock is not available in possession of the client, say his books are telling physical stock of 10 lakh rupees, and books is telling 10 lakhs and physical availability is only 9 lakhs. 1 lakh to the extent of stock is not available. So to that extent, again, block credits. You will have to reverse the ITC as on that particular date and give effect to that particular thing. So as and when you identify that the stock is not in possession of the client, the reversal of ITC also kicks in. Usually client never loss, there's a term which we use, loss mala loss yaar panvanga. So why to have a GST loss? but the law is very clear. If you are not in possession of goods and where you claim the credit, so you will not be given the benefit, you will have to reverse the ITC to that extent also. And we as a statutory auditors, GST consultant, will have to inform the client that GST has to be reversed to the extent stock is not in possession of. We'll stop for a break here. I've given a hint that you will have to stop for a break. By madam, that I'll have to end the session by 1 o'clock so that we can have 10 to 15 minutes of interaction on your queries which may be there. And furthermore, that we'll have this session again interactive and we'll quickly conclude all my slides in the PPT. And we'll have 15 minutes of time where we'll discuss on your queries. So, quickly going into the asset side, trade receivables, GST angle, GST perspective, what to be looked into. That basically your collection from debtors, if it has to be done, what if you were exporting certain things and there is a timeline given to receive the funds. If you don't receive, then what happens? So trade receivables from a perspective of wherever there is an export, you will have to ensure that your funds are received within 180 days. That is the RBI regulations and the export related things where you will have to receive the proceeds in order to ensure that this export of services is export of services. You will have to receive the funds in foreign currency or currencies designated by RBI. Indian currency is also allowed if it is allowed by the RBI as a settlement mechanism, and it has to be received within 180 days. If you don't receive, what happens is your export is not treated as export, it will be treated as a supply and you will be liable to pay GST on it. So this is the impact and this is the approach with which one should look into your sundry debtors or trade receivables in the books of accounts of the clients. Next, one of the important aspects when you are looking into from balance sheet perspective, the GST ledgers, GST credit ledgers, cash ledgers. So these have to be in line with whatever returns have been already filed, whatever ledgers are there online. GST portal will give you the entire ledger. You will have to ensure that these ledgers are mapping or same in relation to your books of accounts. It cannot give a different view. Not only this, as we were discussing, that there may be a scenario where you will have the credits coming to you, but you cannot claim it within the same month. So it has to be parked into a claimable account. As on the year ending, you will have to ensure that there is the liability for the month of March. If it is payable, clearly identified in your financials. If you have ITC credit ledgers flowing in, it has to match with whatever credit ledgers are there in the GSTN portal. If there is any refund which is there, refund which has to be received, you have filed an application, debited, so refund receivable account also should be there in your other current assets. So this particular point, again, GST claimable accounts, wherever you have to do a reconciliation of credits which you have availed but not utilized, you will be utilizing in the subsequent period. It has a separate reporting in GSTN 9 and 9C even. So you will have to report this in table 8D, where the credits have been claimed from April to September, availed pertaining to previous year, availed in April to September period have to be reported separately in the annual return. Same is the case in table 12 of GSTN 9C, where you will have to report that ITC pertaining to the previous year claimed in the subsequent year. And there can be a scenario where previous year's ITC also you will be claiming in the current year. Current year ITC will be postponing it to the subsequent year. So the reconciliation to that aspect has to be very clear, and the numbers reported in your financial statements have to be in sync with the returns filed. Hope I'm clear, right? You cannot have two numbers different at your own numbers at different. It cannot be different in different portal. Your books is telling a different number, your portal is telling a different number. That cannot happen. It will show a wrong. The books of accounts are not right. So it will not be showing a true and fair view to that extent. This cash ledger, again, the differences between the cash ledger, whatever refund you have claimed, so not yet received in your bank accounts, it has to go to the refund receivable account. And TDS credits, one of the important things. Many of your clients, or in fact, will be dealing with certain government agencies, e-commerce portals. So you would have TDS and TCS credits of the client lying. You yourself will not be aware. So as a process of a year-end compliance, one has to ensure that all the TDS and TCS returns of the clients are filed. So what happens when you file your TDS and TCS returns? All the TDS TCS credit comes and sits in your cash ledger. So you will have to file your returns. It is not only GST 1 and 3B return, you have to also file your TDS and TCS returns. Wherever you have a government contracts, you will have 1% CGST, 1% SGST, TCS deducted and remitted in your GSTN. So they will file GSTR 7, whatever is it, GSTR 8. You will have this credit coming in. Only and only if you file the TDS return, it will flow into your cash ledger. Your party's ledger will not match. If you have to look into your party's ledger something receivable, they would not have paid this particular TDS TCS credits. Those adjustments are to be closely looked into before finalization of your accounts. Very clearly ensure that your party's balances are matching. Government contracts, e-commerce operators, your balances are matching. Many instances, you receive a notice of GSTR ASMT 10 that gets converted into a demand, and you make a remittance. Once you make the remittance, you only make the remittance in the cash ledger. It is not knocked off against the liability. So what you will have to ensure is you knock off this particular demands, whatever it is there, against the payment, against whatever is the liability. If you don't do it, it is against lying in your cash ledger. To that extent, one gives a leeway that you will have to ensure the client notices, whatever notices have been received, the demands, the contingent liabilities, you will have to provide a provision or are also taken care while finalizing your books of account. From your perspective, maybe to the extent you are able to gauge how much of liability will arise, or the notices issued is not going to get converted into a liability, you should ignore those notices. Wherever you are thinking that these notices are valid, right, and it may get converted into a demand, so you should ensure that the provision entries are passed in the books of accounts. Right? So wherever the amount is being paid, ensure that it is netted off or knocked off against the liability itself by filing respective DRC 07 forms. Same here, we have already covered that if there is any demand which is paid for a liability which has been, demand has been created and we pay, so it has to get knocked off to that extent. You will have to, the payment when you are making it, it has to have a reference in relation to DRC 03 or 07, whichever remittance which you are making, it has to have a clear knocking off effect. The payment will lie only in your cash ledgers. You will have to give effect by filing the respective forms. Now, so GST liability, again somewhere we have majorly covered this, that GST payable account, output tax, input tax, netted effect, giving marks related entries. So GST amount which has to be paid in the March has to match with whatever liability you're paying while filing the March month return in April month. So the closing is 31st of March, your liability is as on 31st March, your payment is only happening in April. So as on closing, whatever was your March liability should be as a payable in your financial statement. So this again I have somewhere pointed it out that wherever you have applied for a refund and it has got debited from your account and it is yet to get credited to your bank accounts, so you should park it in a refund receivable account. This again, somewhere before the slides have come in, I have discussed with the great enthusiasm that these ITC claimable accounts have to be also accounted for wherever there is a subsequent period claimable, wherever you have availed, not utilized, should get parked under claimable account, respective claimable account. In your case, sir, what journal entries you would have passed for giving effect to Rule 36(4), the differential liability or the differential ITC which you have excessively claimed? Say for example 100 rupees was your credit and you were given a levy of 20% over and above whatever ITC is lying in your GST 2A, you would have claimed 120, right sir? Subsequently, how you would have given the effect?
Sir, it is parked in the input credit account.
Yeah.
So whatever it is eligible, it will be adjusted to that input credit and balance it is carried.
So you maintained only one ledger for identification of how much that 20% excess was there, was claimed?
Plus, we have calculated as per monthly, whatever it is there in books.
Yeah.
If it is far short of that 2A, then only we add it to 20%.
Correct. So there, this way what happens is, your books is showing one number of ITC, what you're claiming is a different number. To match these particular things, you will have to necessarily pass those journal entries to keep a trail of the entire events. Tomorrow someone, my junior is seeing the books of accounts. The first impression he would get is, who has done these books of accounts? No mapping at all. How the ITC claimed is in the books and what is being claimed in GST 3. So he curse me. So to ensure that this particular thing is sorted out, we ensure that we are not claiming this Rule 36(4). And if certain people who were insisting that we claim 36(4), take the benefit of Rule 36(4), we had clear given journal entries to identify that these are the entries, these are the ITs which are claimed over and above GST 2A. So that way the identification was possible, the trail was also maintained. Not only this, many of your clients would have received a notice for Rule 86B. What is this Rule 86B?
Payment through cash.
Good. So this particular thing is, they have brought in, never in the indirect tax law they have connected direct taxes. This provision they have connected there. So what they are telling is, to ensure to stop, manage or keep a check and control for the tax credit frauds which are happening, fake invoicing. So what they have done is they have put a control. So people who are doing transaction more than 50 lakh rupees, you will have to ensure that your outward liability 1% is paid in cash ledger. So ultimately, so to that extent, 86D was to a good extent a tool where government could put a check and control on people doing fake invoicing. So 1% of your outward liability was supposed to be paid in cash. We as a tax auditor have to ensure that wherever there is a turnover of more than 50 lakh rupees, we will have to ensure Rule 86B is followed. Rule 86B, it has an exception giving connection to Income Tax Act. If the proprietor or the director or the partner have paid 1 lakh rupees or more in advance tax or income tax, then this Rule 86B is not applicable. Okay? So this exception, only and only if you respond to the notices you will know. For clients who have not received these notices, this may still be applicable. So you'll have to ensure that wherever the client who has a turnover of more than 50 lakh rupees in a month, they have discharging. There are other conditions even. If you in toto for the year, you pay more than 1% in cash ledger, so the provision may not be applied on a monthly basis also. So rule 86B is a check pointer. Usually we don't check it out. Being in tax audit, definitely will not check. As a pointer, when you go back, see into your tax audit cases, kindly look into the 86B. Maybe department has been proactive in issuing notices under 86B because they have an AI. They issued notices and basis that it would be taken care of. Now, coming to trade payables, one of the key liability side. Now we have covered the asset side. Whenever you are looking into a balance sheet, these are the items which will have a GST implication impact. So wherever not done, it will definitely affect the materiality concept. True and fair value will get affected because it will call for a liability. So one has to ensure that these things are duly taken care before the finalization of books of accounts. Now moving to trade payables, couple of points. Second proviso to Rule 16 identifies. I'll come to this point first and then to the subsequent point. In case of foreign creditors, where you have certain services coming into, you will have to discharge under RCM. Very well, everyone is aware after legislation discussed that wherever you are importing certain services and you are remitting only to the extent of whatever value has to reach the creditor, foreign creditor, you over and above you will have to pay under RCM. So those RCM, whether eligible, ineligible, one has to take care. So this particular thing, when you are reviewing, there may be a majority of the cases that your foreign creditors you wouldn't have discharged GST at all. So you will have to ensure. There may be special transactions where you would have given certain commission. You will have to look into. One of the case, again, if we have to discuss, client was receiving, this becomes a data, trade receivable things. Trade receivable in the terms of clients who are into hospitality sector, who are engaged in foreign tours and travels, they engage service providers outside India. So they do it for a client in India, right? So to that extent, you are doing it on a pure agent basis. Apart from that, they do it on a self basis also. So directors going for a trip outside. So to that extent also one has to take care on GST liability, RCM transactions wherever it is applicable. Now, for domestic creditors, again, second proviso to Rule 16 clearly identifies 180 days. How many of you have done this particular activity? Just get a number. 180 days, clear identification of all the creditors to whom we are making the payment. Whether it includes only cash payments, do I have to make only cash payments within 180 days? So there is a clarification issue that even account settlement will be regarded as settlement for or payment within 180 days. So usually what happens is in a bigger contract, government contract, there is a back-to-back LC, letter of credit. Hope I am getting the point very clear to everyone that there are transactions which occur between the branches, branch movements. Overall effect in the books of accounts, it becomes nil. However, for GST angle, these are all turnovers and it will have an impact. Right? Any points to add? So one needs to understand what are the process and controls while finalizing basically finalizing of consolidated accounts of all the branches. Segment reporting is one angle. In segment reporting also, for books of account purposes, you will have to remove all the branch transfers. Right? For GST purposes, they are turnover. You may have certain turnovers because basis turnover, your e-invoicing applicability and other applicabilities are coming in. Right? So within the branches also we do it as a turnover. It is calculated for the purpose of e-invoicing and other registration purposes. Supply between GST and same pen, we have more so covered this in our discussion. Cross utilization of services. Cross utilization, that is what I gave as a server as an example. This is one activity. So there can be many other activity which a HO will be incurring and the branches are utilizing those services. So it mandates, the GST law mandates schedule, it becomes a supply between related person even without consideration. I have not passed on any money, even then it is a supply. So once that is triggered, you will have to generate an invoice. If you have not generated an invoice, it calls for a liability. GST looks from a perspective of each state. Though we tell one nation, one tax, but when you come to a GSTN, it is looking from a GSTN perspective. The other person, whether related or a distinct person, will have to bill outward supply. The consideration part is not there. In the related party transaction also it will be treated as an outward supply. You will have to discharge the liability. Okay, so this kindly note wherever there are branches for your clients, a cross charge if there are expenses which HO alone is incurring. For example, your audit fees, whether you will have to cross charge your branches also if they are there in the segment reporting and they are contributing to the revenues of the company. So there are many other examples of expenses which are common expenditure incurred by HO alone, utilized by all the branches. So these cross charges needs to be billed. I very rarely do find only MNCs doing it. We have other clients also who have multi branches, but they are not doing this activity. So again, this is culmination of cross charge plus related party transaction. That wherever the transaction is, say for example, you are having a foreign branch also, you are not charging anything. GST law mandates that you have to charge if there is any services which is going from Indian branch to the foreign branch. The valuation rules takes care of what should be the value of the transaction value, what should be the value of such supply. So one has to ensure that depending on the clientele, depending on the number of branches, these particular aspects are also looked into before finalization of the books of accounts. Hope I am clear?
Yes.
So classification issues, peculiar issues with regard to automobile industry, someone into manufacturing. What happens is, you have differential rate within one product. Say for example, again in the automobile industry, spares where the vehicle is at 28%, certain spares are 28%, certain spares are 18%. To give you a live understandable scenario is MRF. MRF had this particular issue where they had tires which are taxable at 28%, tube are taxable at 18%. When they were supplying tire and tube together, they were billing it separately. The packing was happening tire and tube together. When they were billing, it was billing it in a separate way. So department took note of it. They issued. So when there is a composite supply, the tax rate changes. The highest tax rate will be applicable to this. So there is a mixed supply. So tube is at 18, my tire is at 28. The highest rate, 28, would be applicable on both the transaction. So this particular scenario came up to one of the distributors. Then the manufacturer came in, they said, what we will do is, provided you give us DRC03, MRF had put in an instruction to all the dealers that whoever will give DRC03 confirming the payment. Now consider a scenario, MRF has charged the distributors by giving a debit note. It is reflecting in the books of accounts and will make the collection accordingly. They have passed on the credits also. What will happen to the distributors angle? Distributors have sold it to end customer. Now where do I go and collect it from my end customer, the differential 10%? So to mitigate this particular thing, the manufacturer came, not only MRF, you have all Honda, Bajaj, everyone had this issue that certain spares were having a classification issue. They were considering it as 18%, however they were taxable at 28%. The ruling came against them. So the differential 10% was borne by the manufacturer. So what they did was, they made an instruction manual very clearly to the dealers stating that this is the timeline within which if you provide us the DRC03 of your liability which you should have paid to the department, you should make the payment and ask us for the reimbursement. We'll reimburse you that cost. Many of the dealers have not done that and they've lost money. And this will come up, say if the distributor is my client, if I am doing the tax audit and if he has received certain instruction, when will a tax auditor will come to know about this? These are all internal communications. You will not be aware of these kind of communications coming from a manufacturer to your client. So these are all, as a part of audit process, you should ensure that in your discussion, have you come across any communication from your supplier regarding these particular transactions, classification issues, where liability has been incurred. Client has coolly not done the compliance. 3 years down the line, 5 years down the line, they will collect these data from the manufacturer. They will come back to the distributor. They will come back to the distributor and then they will tell whether on your supply you have charged it at the right rate. You have not done that. We will identify the issues and give it to you. Make the payment along with interest. So department is eagerly waiting for those non-compliances to be there, and they are having the database very clearly with them. So once the manufacturer has paid, DRC03 has to come through the dealers also, because the end sale is made by these distributors. So having note of this, the point which I am driving is, there are internal communications from the suppliers, from the manufacturers which are flowing to your clients, which you are not aware, but that may have a GST impact on it. Very clearly, a GST impact will be there along with interest and penalty. Before closure, if you can get those things sorted out, well and good. Impact of discounts. Again, there are scenarios where the discounts are pre-agreed between the parties. To that extent, if it is forming part of the invoice, well and good. Reversal to that extent in GST is allowed. If it is not in agreement, if it is not pre-agreed, then credit notes to the gross amount only can be issued. You cannot reverse the GST component. This is the impact. The outward liability paid stands paid at a higher rate. You cannot get that outward liability paid extra back. Hope I am clear. It has to be agreed. The discount has to be agreed between the parties prior to the transaction. Even if it is prior, determined later, debit note can be issued. The condition is very clear. It has to be prior. Aftermath of those transactions will not call for GST reversals. That is reducing the outward liability. One of the key things in any real estate sector where GST has an impact, you collect advances from the client, there is a milestone to it. Every time there is a milestone, you raise an invoice, you should get the collection done. There are schemes which are floated by the real estate industry, real estate players, that you make the payment, I'll give you X amount of discount and other things. So those amounts are collected in advance, So to that extent, this has to be treated as advances only. And what happens in a scenario where it is an advance? For your books of accounts, it will be a balance sheet item. For your books of accounts, it's a balance sheet item. For a GST perspective, if you have collected an advance, what happens? You have to discharge your liability of GST when you have received the money and take it forward. So, discharge of liability in GST arises immediately. With respect to tax audit, whenever you are looking into advances received for various clients, I've just given you one sector. You may have different sector collecting advances. So, these advances have a GST implication in terms of services. Again, I am putting those words on quotes. Services related advances received is always to be taxed on receipt. You will have to discharge GST on advance receipt. Your books of accounts may show a different picture. It will be an advance and GST will be liable under for those advances. Exchange rate impact, this is more so in terms of your import related transaction or export related transaction. Wherever you take a different number, INR and other things, the numbers reported as per books is different than what is reported in your GST return filing. So one has to be very mindful of again the fact that your shipping bill, the entries, whatever there, the exchange rate which has been quoted there should be there in your commercial invoice also. The exchange rate should be applied in a similar way. The correction which is coming in later on, appropriate entries according to the accounting standards should also be passed. So with respect to non-GST supplies, one has to be very clear that common credits have to be reversed. Your telephone bill, rental charges, those related ITCs from a premises where you apply both taxable as well as exempted supply. Exempted supply includes your non-GST supplies even. So rule 42, 43 reversals are applicable. Majority of the cases we have noticed that client never does that. So a leeway has been given in terms of not complying it on a monthly basis, but at least on a yearly basis you have to do it. So before finalizing any of your client's account, you will have to note down the nature of transactions concluded by your client, whether it has any exempt supply, non-GST supply. If he has mix of both taxable and exempted supply, then ITC reversal on the common credits is applicable. You should give effect to that. The calculation is at your liberty, but to that extent you will have to do some reversals at least, right? So the mechanism is very robust. You will have to put the numbers right, it will give you the numbers again. There is a 5% reversal on all credits by default if you have a taxable and exempted supply for non-business purposes. If someone who has looked into Rule 42 in detail will know that there is a 5% reversal for non-business purposes, and which is quite huge. If there is some company which has 100 crore or 1 lakh rupee or 1 crore rupee of ITC, 5 lakh rupees there, you will have to reverse if you have to apply the provisions of law. Rule 42 very clearly identifies 5% for non-business purposes. So this majority of the clients, auditors, we don't do it. So for that, maybe a proper disclosure to that extent in the tax audit is mandated. You will have to give effect of these things very clearly. Gone are the days where it could have been ignored. No, these are now very clearly visible from the tax returns of the suppliers, and the data is very in a dashboard format available to the department, so they will be in a position to calculate these numbers. Expenses reimbursement. We also have these kind of reimbursements coming to us, right? When we file company secretarial related compliances and we charge the client, we have one amount which states very clearly out of pocket expenses. Out of pocket expenses in terms of actual spend, they are a pure agent concept. Rule 33 allows for that. It is not taxable. To the extent if you have a markup anywhere, even rupee 1, that becomes a taxable supply. So, while finalizing, one has to be very clear that the expenses of whatever reimbursement which the client is taking, either it's a balance sheet item, if it is coming in the revenue fold, definitely it has to be taxed. It's a taxable supply. Clear everyone? The reimbursement part, if you have a markup, say my registration fees if I have paid or whatever ROC fees which I have paid is 600 rupees and I collect 650 rupees from the client. For that 50 rupees I will have to either treat it as inclusive of GST and discharge my liability, or department will come and charge you 50 rupees. They will calculate on 650 itself and then they will give you an opportunity to represent that no, I have incurred 600 rupees only for the client. So your invoicing, your revenue recognition has to be very clear. Any markup of any sort on your expenses reimbursement will have a direct impact if you are a GST registered person or your client is a registered person. Clear? Those accounting standard adjustments which we have already discussed in terms of balance sheet items will also apply here. This recognition wise, how much of revenue, milestones, real estate sector you have certain milestones, till that time you have to recognize the revenues. However, I would not have that much of collection in my GST from the customers. I will have to recognize my revenue based on whatever milestone I have received. Okay, so that is the impact of this accounting standards adjustments. In days adjustments similar to that, we'll have to have these adjustments which have a differentiating impact based on the turnovers or whatever adjustment it is there. You should have a reconciliation of it. Tomorrow, why this difference? Why this difference? The working paper should be very clear in those terms of these kind of adjustment, in days or accounting standard adjustments. You will have to clearly identify and keep it in your working papers. So annual return, I'll just brush up on what annual return is, what are the due dates, and just taking into consideration what happens, how one has to read the law to get a rightful insight. I wanted this to be showcased. I want everyone's attention here, so that there has been certain important amendment or substitution to the section itself of the annual return. So how we interpret is important. Now, to ask you a question, can anyone tell me how the annual return has come into existence, or maybe which section gives the power? One has to be aware, if we are filing annual return, RICO statement, there has to be some powers. RICO statement 35.5 was the audit. Now they have cut down that particular section. Now, annual return section 44 gives the power. Section 44 of the CGST Act requires every registered person other than ISD, casual taxable person, non-resident taxable person to file a return, annual return. What it states is, including certified, self-certified reconciliation statement. So if one has to look into the annual return, 9 and 9C is annual return. Am I right? We'll read the section. This is the section, if I have to highlight. See, every registered person shall furnish an annual return which may include a self-certified reconciliation statement. It mandates you to file a reconciliation statement also in form what? So for that prescribed form, within such time, in such form and such manner as may be prescribed. Whenever these words are used, where do we go? We'll have to go to the rules to identify what is the manner prescribed in which we'll have to do that. So going there, we are looking at rule 80, input service distributors electronically in form GSTR 9 before the 31st day of December. Before the 31st day of December, following the end of such financial year through the common portal. So this is the form 9. This is the power of annual return. Now what it is asking you to do is file a self-certified reconciliation statement. Where is that format? Come back to 83. It is telling, furnish a self-certified reconciliation statement as specified in section 44 in form GSTR 9C along with this. So I can easily conclude. So, and one more thing, where is this 2 crore limit coming from for the annual return? We have been doing this. Now I want the members to be little active. This is an interesting thing which I wanted to highlight, and I spent today morning 2 hours. Right from 12 o'clock I came here till 2:30 I was doing this particular slide to just explain how the law is giving contradictory things. Annual return, it is asking me. So it is telling me every registered person other than so and so, so and so, so and so to file an annual return in GSTR 9 along with a self-certified reconciliation statement. So it is mandating that someone who is filing annual return should file 9C also. Correct? Is it right? Correct now? We'll rush up little. I want little interaction so that we can make it very interesting. So the annual return powers are coming from section 44, read with rule 80. Rule 81 provides for GSTR 9, but it is not mentioning the turnover limit. Where is the turnover limit coming from? Huh? Notification. Can a notification override the act? Can a notification override the act? If I have to plain vanilla read the section number, it states that it is applicable. So certain places you can tell what is the limit has not been prescribed. Right? Where is the limit prescribed? So it is telling every registered person. So for every registered person, limit is not there. They have created a boundary. Okay? This boundary has to come with powers. So in section 44, proviso, Commissioner may, on the recommendation of the Council, by notification, class of registered person from filing of annual return, exempt any class of person from filing the annual return. So he was right in telling that this is a delegated legislation, forced delegation. Right? Act cannot delegate the powers very clearly, but it has delegated through a notification. The limit has been specified. Which notification? Which notification? If I have to ask whether the notification is blanket open or whether it has to be given for every year, for every registered person. So here provided the Commissioner may, on the recommendation of the Council has to recommend, the execution has to be done by Commissioner through a notification. Right? So the notification issued for financial year 2021 is 31/2021, dated 37/2021. If not for this particular notification, annual return was applicable to every registered person. If not for this particular notification. Same way, very clearly identified for financial year 21-22, 10/2022 is giving that particular leeway. Tomorrow, if the client is asking, annual return applicable, sorry, I'm using Tamil as a language. Hope. Okay. So this particular thing will have to be, the reason I brought this slide is, when you leave from here, someone who is asking you, annual return what is applicable? So section 44 read with rule 80 and those particular two notifications for financial year 2021 and 21-22, very clearly highlighting that. Now coming to the question, again moot question, annual return 9, what is it? GST and 9 and 9C, both annual return? If I read the law as it is read, yes it is. Earlier it was different. 35(5) gave the powers, 35(5) to 40, section 44 and then 80. So it had its own existence. A reconciliation statement certified by a chartered accountant or a cost accountant. So it became a GST audit. We usually use the word GST audit, right? So now, wherever the annual return is applicable, reconciliation statement is mandated by law. How to get away from this particular mandate? Now we know by a matrix that more than 2 crores of turnover, annual return applicable. More than 5 crores of turnover, GST or RICO statement applicable. Where is that coming from? If I am applicable, if I have the applicability of annual return, reconciliation statement comes along with that. But we are not doing that. Again, stating rule 83, which clearly identifies that you have to do it before, again, 31st day of December following the end of the financial year. The limit prescribed again has been more than 5 crores. That has come through. So the powers again for this particular thing is not there. No one can, if you receive any notices for reconciliation statement, you can receive. And department will be right in that end. Annual return file panithinga along with reconciliation statement you should have provided. Reconciliation statement not mandated but prescribed is GST or 9C. You could have given reconciliation in any format if you wanted. So GST or 9C, again aggregate turnover, So aggregate turnover during a financial year exceeds 5 crores rupees. So this is the way a combined reading of section 44, rule 81, 83 gives us an idea that the matrix, more than 2 crores of turnover, GST 9 applicable, reconciliation statement optional. Come down, more than 5 crores of turnover, both applicable, that is GST 9 and 9C. Clear? Clear everyone? So when we are taking home, we know this notification number also, 10/2022 is the notification number which gives the power for exempting annual return for registered person having less than 2 crores of turnover. So I will not deliberate on this one because everyone is aware, 3 years, 4 years, we have filed 5 years in fact, if you have not filed for this year. 3 years, 4 years we have filed this particular annual return. So each part 1 is general information, part 2 with regard to supplies, part 3 for ITC related, part 4 is for the taxes paid, part 5 is for subsequent period items, and then the other details, other information is this. So GSTR 9 annual return, more so the data has to be ready. When I mentioned that ITC related reconciliation, other ITC related information will have these details of credit availed in the current year but utilized in the subsequent year. That will be a reconciliation item as per our books. So 8C, 8D are the line items which have to be reported. So reconciliation statement I have already discussed. The notification number relevant here was 40/2021, where they have resigned at 35.5. They have removed the 35.5. So the audit provision pertaining to GST audit has been removed. 35.5 has been removed. The relevant notification number was 40/2021. And if you read the thing also, it identifies, it gives interlinking connection. So GST 9 should be submitted along with annual return. So the point to be noted here is, shall also furnish reconciliation statement as specified in section 44 in form so and so along with annual return. So here is where for people who are having turnover of more than 5 crores, you have to submit along with the annual return. So compliance approach, how have we been doing? Each one knows their way of approach. Audit MD, how we are completing the audit. Books of accounts finalize due date what the finalize panno. We'll have to complete them. Somehow, some way we'll have to complete to keep the timelines on track. So as a matter of practice, what we do is, we do the compliance right. GST comes later only because the due date for that is 31st of December 20 of the subsequent financial year, following financial year. And what happens is, the due date, what we usually do is, we look into every other act, Companies Act, Caro Parthikron, we look into Caro, we look into income tax, we look into every other aspect of loss, PF, ESL, we look into when we are doing the tax audit. But some part of it we are taking care in the GST law also. I don't think we would have taken care of this delicately. So the reason of having this particular seminar, the rightful mind of chairperson, that it has to be done. It has to be done in the right manner. Never late. We should have done this particular thing by June, July itself. September, good time. You can revisit the tax audit whichever you are going to sign, and then you can take a. So now the approach with which the people are doing this particular activity, I've given it in a flowchart manner. But the point again is, the approach of getting into GST at a later point of time will always have certain impact on whatever you have signed earlier. So you will have to be very, very critically sound enough in before signing whether I have taken care of the GST related aspects or not. What we usually do is, we sign it, we find certain findings which are coming in GST annual return and audit report, and we think, what, but that is not the right approach. So this is the flow chart. So preparation of books of accounts starts first, then we get into finalization of books of accounts, then the tax audit report, then income tax filing, company secretarial compliance, and finally, so if you see, the ongoing process is the preparation. We get into April to July of every August, whatever is, into finalization of books of accounts. Tax audit, September, October, whatever, depending on the clients. Then income tax filing, which almost happens on a same timing. Company secretarial, 1 month from the AGM. And GST, we take it at the fag end, last, because the due date is such that we only take it in the December month. So the ideal approach should be this particular GST annual return coming right in front before finalization of accounts. That is the right approach of getting into finalization of books of accounts and then filing your tax audit report. This particular sums up the entire presentation which I wanted to do. That the approach with which we are following is that books of accounts is an ongoing process, finalization happens, we file tax audit report, income tax returns, company secretary, then we come to GST. The points which I have discussed, GST related, even if there is one trigger, it will affect your books of accounts. And for that, at least you need to freeze the things here. Right? So, just 5 more minutes. I'm correctly running on time to discuss on clause 44. Don't worry, when I said 5 minutes, it is 5 minutes for the reason that clause 44, though complicated, they don't know what they brought into. Frankly, the department who brought this particular clause 44, with what mindset did they bring? Can anyone tell me when did this actually come into through a notification? 2017, 19. I can assure you that before you leaving today's seminar, you will know the complete background of clause 44 in the sense when it came and now why it is applicable. The point is, someone who is asking clause 44 எப்போதான் வந்தது தெரியல. Can we tell that as an answer to anyone? That gives us the confidence. No, that is not the right approach. Clause 44 came up with from 20th July 2018 through a notification, 666 notification issued by again CBDT, that clause 44 becomes part of tax audit report. So very clearly that section 44 AB and the relevant rules read with had this particular thing that 666E notification issued dated 20th of July 2018 brought into existence this clause 44. What happened? We'll see here. Within 1 month, no, not possible. We have come out with certain regulations, not possible to get the things sorted out. Certain representations came in. How is it possible? This GST has only been 1 year and you are asking us to report these numbers. How is it possible? The system is not ready. So within 1 month, 17/8/2018, hardly 27-28 days, they came out to put the abeyance from what? Till 31st of March 2019. Don't worry, you don't have to do it. Whatever tax audit report you are signing, 31st March 2019, no problem, it is at abeyance. Then again, 14/5/2019, they came up. Same issues cropped up. It has been only 1.5 years or 2 years. Right now, GST itself is not right. The portal itself is giving so much of issues. How do we expect professionals or Audit to have these details ready? So they further extended 31st July 2020 the due dates. What happened further? COVID. Don't worry. We will issue a circular stating that it is at abeyance till 31st of March 2021. When was this circular issued? Again, April itself. COVID நடுல எப்படியோ வந்துச்சு. ஏதாவது relief கொடுக்கணும். Some relief has to be given from income tax side. We'll give this relief. Peak COVID. Understand that. March, April 2020, they come out with a circular telling that we will give relief. As if we were waiting for this relief to come and then we will report the numbers. Now, going forward, what happened? Circular 5/2021, dated 25th of March 2021, gave what? Don't worry, COVID is continuing. We will also continue abeyance 31st March 2022. Now, nothing doing, no circular, nothing has come in. So, what does this imply? What does this imply? Hope everyone has got the background. Right from 2018, like a story it went off, COVID came in, COVID extension, abeyance till 31st of March 2022, it is an abeyance. The circular, last circular issued by the government was Circular 5/2021, where it stated till 31st of March 2022, we will keep it at abeyance. I have clients, 3-4 clients who have not filed tax audit for 2021 financial year also. What will happen to that? The ambiguity is still there in the circular. It is not telling that for the financial year pertaining 31st March 2022, 31st March 2022, we are giving a leeway. So the ambiguity still stays there. So whether my financial ending on 31st March 2022 needs to be done or not, or 3CD, whatever I am submitting, in respect of earlier financial year also is to be included. The ambiguity still stays there. What combined reading or maybe an understanding is 31st March 2022 is the date till which it is kept in abeyance. Post that, whatever tax audit report you are filing, you will have to report these numbers, be it for whichever financial year you are filing the tax audit report. Okay? Be it 18, 19, 19, 20, you will have to report these numbers. Right? Moving forward, everyone would have gone through this. We'll see what it is. Can anyone understand what they are trying to get out of this particular thing? Another number crunching exercise for chartered accountants. Nothing else. For me, I could not understand why they are asking for this particular number crunching. They are asking GST expenditure in respect of entities registered under GST. My client data ve kuduk maatendranga, registered e unregistered ah treat pandranga. You want me to give a number with this particular breakups? On top of it, total expenditure. How do you interpret this particular number? Total amount of expenditure incurred during the year. Do I look into my P&L debit side? Whatever is there, do I do that? Is that the right approach? Whether depreciation is an expenditure? Bad debts? Too much of thought process to be given. Purchases to be included? It's an expenditure, right? To be included? To my view, purchase to be included, depreciation, bad debts not to be included. What happens to non-GST supply? What happens to non-GST supplies? What happens to exempt supply? Exempt supply, definitely they are asking here. If it is with the registered person, unregistered person or exempt supply in the. So the confusion is quite huge. Not only that, just get through this particular format. Where are they asking you the detail of expenditure at all? Particulars of expenditure, there is no. Where do I give my rental with related person? Not. I'll give a number, give the breakup here. What data it is, who will understand? But I will have to keep my working papers. How have I derived these numbers? So, for me, this activity is nothing more than a number crunching thing, and it is only the right way of approach to this particular reporting is no one can give right now. No one on this earth can give right now, including CPDT cannot give you what kind of approach. Somehow, our institute has done their bit of work, given a guidance note. They have discussed almost 13 points or 14 points on what should be the interpretation or what is the demand with which this particular request is being placed. So, going with the serial number 1, column number 1, there is a notification, total expenditure. Again, breakup of these expenditure, how will you give? Because you are not giving particulars. So the only thing which I can gauge off is I can have rental expenditure, I can have showrooms which are with registered person, unregistered person. How do I report? One number, how many columns do I report the numbers? So these are all breakups which you have to give. Now getting into a little more detail, when they are asking for exempt supply, how do you get into? And this is where somewhere it mandates the people who are only into direct tax practice to get involved with GST also. Exempt supply, if one has to imagine, it includes everything and other than GST taxable. Exempt supply or definition like non-GST supply, non-taxable supply. So includes non-taxable supply. So exempted can come with three things. One, directly given in the rate schedule as nil. Second, a specific notification itself is given as a exemption notification. For goods it is 2/2017 rate notification. For services it's 12/2017 central tax rate notifications. Export related transactions where we are doing with exempted products. So these are there. Not only these, which will include non-taxable supplies. What are non-taxable supplies? So I didn't want to make the PPT too long. So non-taxable supplies, again, section 9 of CGST Act, section 5 of IGST Act gives that something which is, there are only two products, which is one, alcoholic liquor for human consumption, and petroleum, crude oil, aviation turbine fuel, motor spirit, high speed diesel. Those things are kept outside the purview of GST. So that becomes a non-taxable supply, right? So those are the numbers which are to be reported here in exempt supply. How you will crunch the number? Play. To the extent possible, you will have to extract these details. Client were not aware, and till date they are not aware, I am telling you. Client till date they are not aware of this particular clause and how they have to maintain their books of accounts for the audit team to ensure that the number is derived. They are not doing it very clearly. So this awareness has to flow into the auditee or the company or the client for whom we are doing the business for tax audit. You will have to give them a particular template in which they have to give these details, at least for reporting purpose, at least for their working papers, right? So going into this, whatever numbers are reported here gets break up into this relating to composition scheme. How do I identify composition scheme? The client has a peculiar habit of taking this composition scheme into unregistered only, very clearly. So this becomes a challenge to identify those things. The composition dealers issues invoices as a bill of supply. They don't issue an invoice, they issue bill of supply, clearly highlighting that they are registered as a composition dealer. So that is the way you identify. Alternative approach is get the client's GST at web or books of accounts, get the GST number, cross check that with the portals. For each activity I have to do, then you will have to find a way to automate the process. That is where I somewhere highlighted, or Madam also highlighted, you will have to grow, you will have to develop yourself to safeguard your time. We have developed, we click a button, it gives the entire 1,700, 2,000, 3,000 line items of GST verified in less than 5 minutes, giving us the details of who is composition dealer, who is taxable person, who is TDS registered person, who is ISD. So less than 3-4 minutes it gives us the details for 1,000 line items. So this is the somewhere which the point which again I am driving is everyone has to be robust, tech savvy, understand what can save our time, and then ensure that these compliance are done right. Okay? And just to quickly sum up, so the sum up of column number 6 would be 3 plus 4 plus 5 is equal to 6. Is that right? Total payment to registered person. There are two school of thoughts for this also. What actual payment I have done, I will have to do, no? Be it advances, be it anything. The banking transaction, look into the ledger, whatever is the payment, put the number there. So will you do it for 1,000 suppliers or whatever the expenses is? How will you identify? Will you get this particular details? Big challenge, but you will have to do it. The thing is, somewhere you will have to work in and around the GST Act ITC angle and then do it. Expenses. Majorly ITCs are pertaining to expenses and expenditure, so you will have to take care that way. And finally, the expenditure relating to entities not registered under GST, they want to get a statistics basically. Evlo registered person, evlo unregistered person. For this statistics, they are breaking our head by not giving the format also in the right way. At least if they would have asked the particulars of nature of expenses, we could have given. We have identified this in table 14 of GST and 9C. Expenses wise, we are giving those details. Whoever has filed the annual return reconciliation statement, table 14 has that kind of details, ITC available. The breakup of these expenditure to registered and unregistered, then we'll have to again, data mining has to be done. The points to ponder I have actually already discussed that were there in my mind. So I'll just point out. So this, whether I'll have to report only revenue expenditure or capital expenditure also. So very clearly identified, it says expenditure. So you will have to ensure that both revenue and capital expenditure are forming part of the reporting which is being done in clause 44. So already discussed on what will happen to schedule 3 items. Big question mark. Transaction neither treated as supply nor services. For example, your employee-employer relationship, you pay salaries. Whether that should form part of this particular reporting? Answer please. Why?
I use the term supply.
Is it expenditure? Where is the term used supply? Where is it? It is only using the word expenditure.
They have given the bifurcation.
Right.
In that it is not included.
So can I treat this as in residuary category? Can I treat that in the residuary category? Or report only here? It is not registered, right? So I will have to report here. What will happen to an import of services scenario? It's an expenditure, right? I'll incur architect. Let's take our own example, the architect fees which we are paying. It's an expenditure, but he is not registered in India. GST, but that expenditure is there. So where will I report that number? Unregistered person. Sure. A twist. When you pay under RCM, what is the mandate which is given in GST law? You have to raise a self-generating invoice. Invoice on myself. So I am a registered person generating invoice on myself. So I become a registered person, no? Kindly answer. Where to report? 5, 7. Quickly. Lights are on there. Hinted me. So quickly.
7.
I'm sorry, I'm not in a position to comment right now. So I generate a self invoice on myself whenever I have RCM transaction. So those again are grey area which one has to. Right now the right reporting would be in 7 only. One has to look into because you are generating an invoice, self-generating invoice, so that becomes a challenge. So there may be certain instances where for a person tax audit is applicable, GST registration not mandated. Clear-cut case, legal practitioners, lawyers, doctors, but then it is applicable. Whether I have to report for them also here? You have to report. It is only asking for expenditure, sir. GST registration is not mandated to report this particular clause. You will have to report on expenditure angle very clearly. Very clearly, you will have to report these numbers. Transaction liable to RCM already discussed. So according to my experience and other things, and what institute has come out with certain details which you should expect from the auditee or the client to give you, and then derive is this particular template of 8 columns, where you ask them what is the expenditure head, name of the entity for which the payment is being made, GSTN, value debited in the expenditure account, basically P&L, value for which input tax credit is being claimed, total amount paid to the vendor. If there is a nil rating, why nil rating? Reason for that, which will give you the exempted related, and general remarks. So these details you will have to share when 2018 ले share पन्ने at least April 2019 you should have done, no? Or sorry, April 2021 you should have done for the 21-22 tax audit report to be signed in a clear way. This has been the case. We'll have to give the guidance to the clients, tell them that you will have to maintain at least for 22-23, if not done earlier, or maybe data mine, pass on that activity to the client and let him do the activity. So certain disclaimers based on senior professionals who are into direct tax compliance, they had shared that what happens in 3 situations. One, where you are not providing any information in clause 44. What disclaimer I can provide? What thing, how I can give it as a qualification or observation or whatsoever. Tax audit definitely has a column where you can give your observations, right? So where this information is not there, see these things again, to the extent possible, it is our responsibility to give the information. By merely mentioning these disclaimers, you cannot escape the requirement of giving the details. So the details is as informed by the assessee, the information required in clause 44 not maintained in the absence of disclosure requirement. Further, standards of auditing software used by the assessee does not maintain or give this information ready-handed, and it is not possible due to paucity of time. We cannot give this detail, and hence we have not given these details. The thing is not maintained by the client. Then you can give this. Next, assessee not registered under GST, which we have already discussed. Say the lawyers, doctors, and other things. You can give this particular, if they are maintaining, well and good. If not, the same kind of disclosures. Third is providing information, however, limitation to, that is safeguarding yourself, that based on whatever information provided by the client, we have compiled the data, this is the data company. May or may not be true. Correct? So ultimately what we are doing is, we are forming a true and fair view on the balance sheet, and the tax audit report covers a part of it. Companies Act wants you to do a true and fair view. Auditing standards, accounting standards, you can rely on work of others, but ultimately you are signing it. That's why I refrain myself from attest functions. Thank you. This was my time. Thank you very much.